In today's stock discussion, we're going to have a look at 9 stocks which I'm feeling bullish about. A 20 to 30% upside seems possible in these stocks and the risk level is relatively low. Now some of these stocks are going to be from the large cap category, and that's because in the last 1 or 2 years a lot of money has moved out of the large caps, and that has created good investing opportunities in that space. Now in one of these stocks some recent developments have happened which you will come to know in the later part of the video, and then you can decide whether to include that stock or not. Namaste and welcome to Retail Investing. So stock number 1, if you own a house, you may already be a customer of this company because this company manufactures tiles. The name of the company is Kajaria Ceramics, and here is the chart. So as you can see, there has been significant corrections in the stock recently and it is currently trading at 1276 rupees, just above its 200-day moving average. So Kajaria Ceramics is the top manufacturer of ceramic and vitrified tiles in India, and its global ranking is 8. Bathware and plywood are also parts of its businesses, but it does not manufacture plywood, only trades in them. So here is the financial overview and all the numbers look good enough. The return on capital employed and the return on equity are above average. The debt to equity ratio is extremely low at 0.07. So this thing makes it a low risk bet. So why do I feel bullish about this stock? Well, the housing sector is growing and people's aspiration levels to build new houses are at all-time highs. And after building one house, many people are building a second house as an investment. Now, I'm not going to question the merits of such investments in this video, but it's quite obvious that the demand for tiles, bathware and plywood are going to go up. And for that reason, I think Kajaria Ceramics has upside potential. Stock number 2 is the State Bank of India. Now, this company has a huge customer base of 48 crore people and has 1/4 market share in the loans and deposit segment. It is a Fortune 500 company and not even HDFC has achieved that feat. So here is the chart. As you can see, it is a very volatile kind of stock and currently trading at 579 rupees, which is quite close to its 52-week low of 499. The current price is just above its 200-day moving average. A stock with good fundamentals and high volatility is the favorite of the trading community. And without any surprise, its weekly traded volumes are very high. As we all know, it is a public sector enterprise and the union government holds a 57.5% stake in the company. So here is the financial overview. The fundamentals are good. The price looks to be below its fair value. The price to book value is 1.44, which is very attractive, and the PEG ratio is only 0.1. That seems to be undervalued. As per the latest quarterly earnings report, the revenues grew by 22% and the profit after tax grew by 44% on a year-on-year basis. So that makes me feel bullish about the State Bank of India. So stock number 3 is SBI Cards and Payment Services. It is a subsidiary of the State Bank of India, but it is actually registered as an NBFC. So here is the chart. As you can see, the stock has seen significant corrections since June. Currently it is trading at 753 and it's very close to its 52-week low and below the 200-day moving average. The financials are strong. Price to book is 8, the PEG ratio is 1, but both the revenue growth and profit growth are solid. The company's ranking is 2 in terms of cards in force and the amount of money spent. As per the latest quarterly report, the net sales are up 20% compared to the same quarter of the previous year. The demand for credit cards are going up and it's a high interest lending business. So an upside potential of 30% can be expected. So stock number 4 is Crompton Greaves Consumer Electricals and it is from the consumer durable sector. So here is the chart. As you can see, there has been complete destruction in the stock since October 2021. It's currently trading at 282 rupees, which is very close to its 52-week low and below the 200-day moving average. Its products are fans, pumps, appliances like water heater, air cooler and LED bulbs. So here is the financial overview. The fundamentals look okay. The return ratios are above average, but as per the PEG ratio, the stock is still overvalued even after all the corrections. But now the thing is, the PEG ratio can easily improve if the earnings growth improves, and there is a good chance for that happening. In financial year 2024, they have plans to make huge expenditures on brand building through marketing. If this marketing campaign works, the earnings are likely to improve. Stock number 5 is Kotak Mahindra Bank, and it is one of the safest stocks out there. So Kotak Bank has a very diversified business and their business segments include retail banking, corporate banking, investment banking, stockbroking, vehicle finance, life and general insurance. So here is the chart. The stock is currently trading at 1745 rupees, which is way below its 200-day moving average. The stock price is pretty much at the same level it was 3 years ago. But in these 3 years, the business has moved a lot. The profit has compounded at 20% during that period, and this is how valuations of companies improve. So price to book value is just 3. The net non-performing assets is quite low at 0.6%. Earnings per share growth is high. The return on equity and return on assets have both been improving in the last 2 years. In the last few years, most major banks have failed to generate any returns for their investors. The situation is likely to change, and that's because their businesses have been improving. So Kotak Mahindra Bank seems to be a safe bet. Stock number 6 is Reliance Industries, and this company is everywhere. Petrochemicals, retail, digital services, telecom, green energy. So here is the chart. Pretty big corrections have happened since July, and right now it's trading at 2315 rupees, which is way below the 200-day moving average. It might sound funny to you, but I'm going to call it a low debt company even after looking at its debt of 3 lakh crore rupees. That is almost equal to the entire market cap of Kotak Mahindra Bank. Now why I'm calling it a low debt company is because its debt to equity ratio is only 0.42, and its revenues are extremely high. Plus its reserves stand at 7.5 lakh crore rupees, which is more than the entire market cap of our next stock, ICICI Bank. So here is the chart of ICICI Bank. Compared to the other major banks, the ICICI stock has performed decently in the last 2 to 3 years. It's currently trading at 939, which is very close to its 200-day moving average. So the financials are looking good. The return on equity has been improving. The return on assets has been improving. Mutual funds are increasing their stake in ICICI Bank. The price to book value is above 3, and the market is clearly giving it a premium compared to the other major banks. So a 20% upside in the ICICI stock seems very reasonable. Stock number 8 is the most obvious stock, HDFC Bank. So here is the chart. As you can see, there has been a big correction since July. Its current market price is around 1500, which is much below its 200-day moving average. In the last 3 years, the HDFC stock has been trading within the same range without generating any returns for its investors. But during this period, the business has grown a lot. The market still feels uncertain about the outcomes of the merger, but I am bullish on this stock mainly because its profit growth has been impressive and the management is very competent. So they have plans to add 1500 branches every year and transform HDFC into what they call a tech company which is into banking. This is a very confident expansion plan, and I think it is safe to bet money on this franchise. The quarterly results in the last 2 years have been good. Net profits have improved, book value per share has improved. The foreign institutions have been increasing their stake. So it looks like a green signal for me. So stock number 9 and the last stock of this video is Indraprastha Gas. So here is the chart. As you can see, the stock has recently seen a huge crash, and the reason for that is the latest EV policy of the Delhi government, which I am going to explain in a moment. But before that, let's have a look at the financials. So the return on capital employed is 26.7% and the return on equity is 20%. These are excellent numbers. So it is basically a zero debt company with the debt to equity ratio of only 0.01. And the generation of cash flows is very powerful. The company's business is gas distribution in the NCR. Now CNG is widely used in commercial vehicles in and around Delhi, and the company gets a lot of its revenues from supplying CNG. So recently the Delhi government has announced its EV policy, and according to this policy, in the next 3 years, 50% of all new vehicles purchased will be EVs, and in the next 5 years, 100% of vehicles purchased will be EVs. So this raises concerns about the future prospects of the company. I was highly bullish on this stock before this news came out, but as of now, I'll put it into the wait and watch category. Now don't forget to type in the comment section what views do you have on these stocks. If you got anything valuable from this video, please like and share. And if you don't want to miss future videos on investing and stock market, consider subscribing. Thank you very much for joining, and I'll see you in the next one. Jai Hind.